We're taking a look at the currency market now with Shireen Darmalingham, Macroeconomic Strategist at Standard Bank. Thanks so much, Shireen, for joining us this morning. Well, there's no other way to explain it other than markets are wildly swinging and hard to see which way things are going to swing next.
Yes, yesterday we saw that despite the fact that we had disappointing US and SA data, the rand continued to enjoy extended short covering from the 8.20 levels that we saw at the beginning of the week. And it really reinforces our view that the rand could possibly trade within a range of 770 to 820 in the near term. We also had the ECB cut that interest rate yesterday, as well as the cancellation of that very controversial Greek referendum, which really was the primary trigger for which spurred investment, or rather risk appetite yesterday, and really caused the rand to firm. And we do believe that going into the weekend we could possibly see a retracement back towards 770, especially if the US payrolls data surprises on the upside. So in all, risk on sentiment, given the fact that Greek referendum has been cancelled.
Of course, we're anticipating the results of that confidence vote later today, and that keeping some in the market apprehensive right now. Let's reflect back to that ECB rate cut decision, because very much in line with what you were telling us yesterday, that was Standard Bank's view to start off with. You were backing from the overall consensus yesterday, where the expectation was that rates was going to be kept on hold. What does that imply about Standard Bank's view in terms of the EU economy and where we're headed?
Well, our view really centered around the fact that we are expecting a mild recession, which is what the ECB president had indicated. What is concerning, though, is the fact that if that recession does materialize, it does obviously have significant contagion implications for the rest of the world and for South Africa. And that really is what has concerned us. We do believe that the cut really came at a very good time, and we do expect that the ECB president continues to cut rates at least in November and going into the new year. Possibly not into the new year, but at least in November, given the fact that that mild recession is on the cards and they do have to stem that recession and really stimulate demand and growth in the economy. However, given the fact that Greece is really in the position that it is, we could possibly see sentiment turn as quickly as it did turn yesterday as well.
Does that stand in contrast to your expectations for the US economy? Because we've started to see, as you said earlier, that US economic data filtered through. It was pretty mixed yesterday. Jobless claims are coming in better than expected, but then the services sector growth slowing modestly in October to its lowest level since June, and showing that new orders declined. What's your view on that economy?
Well, we do expect softer growth coming in from the United States. Yes, yesterday we did have mixed data, and today we're probably likely to have mixed data as well. We're expecting non-farm payrolls to come in slightly lower than what we saw the previous month, but we do expect the unemployment rate to remain at 9.1%, and that is a little bit of positive news. But we could also see that number surprise to the downside, especially given the fact that the economy is very fragile and the world economy very fragile, and the uncertainty surrounding growth in the Eurozone and its impact on the United States and the rest of the world is really what is concerning at this point.
So is QE3 still on the cards on your table over on that end, because that would have implications then for dollar movement moving forward?
And while the Federal Reserve has indicated that they would obviously implement some kind of monetary policy easing, so we could possibly see QE3, but also, I mean, as conditions change over the next couple of weeks, we could possibly not see that happening. We have to wait and see what's going to happen and what's coming out of the Eurozone today to really have a full assessment of what's happening in the global economy. At this point, it doesn't seem as if any action is likely. Well, we do expect a vote, a yes vote, or a vote of confidence, but we haven't really seen action come through over the past couple of weeks from the Eurozone, and that's really the big thing at the moment. I think participants need to start voting with their heads rather than their hearts at this point.